Welcome. My name is Scott Choppin. I'm the founder and CEO of the Urban Pacific Group of Companies. Urban Pacific is a real estate development company specializing in workforce housing. We're based in Southern California. And the purpose of today's video is to talk about workforce housing as an investment model, a new trend that's happening in the marketplace. Some people describe it as build to rent. Some people call it workforce housing. We actually, in our model, Urban Townhouse UTH, actually combine the two, build to rent plus a workforce middle income housing style. My purpose is to enlighten you and expose to you this new trend, some of the characteristics of why it's increasing in demand, and specifically the innovations that are related to tenant attraction, meaning demand for these units in the marketplace, even in the midst of recessionary environments, as well as what's the innovation for investors and why you should consider this as an investment model for your portfolio. So welcome, and we appreciate you being here, and here we go. So what is workforce housing? Workforce housing has many different definitions in the real estate development marketplace. So one of the things I like to do is basically define it for people in the context of the conversation that we're having today. Now, because there's so many different definitions on a broad base, we can assume or know that it can apply to both for sale and the rental housing model. In today's presentation, I'm going to be talking about workforce housing from a rental housing standpoint. For us, workforce housing is really a middle income housing product type. So we house in our UTH or urban townhouse model families that generally land in the income categories between 80 to 120% of area median income. Now, that's not a strict rule. This is not government subsidized or what we call true affordable housing. This is a naturally occurring, privately financed workforce housing model. Naturally occurring means we produce rents that fit these middle income family and roommate group categories, like it's affordable for them naturally without government subsidy. That's what naturally occurring means for us, is that there's no government subsidy. And in the environment, you really have two spectrums. You have true affordable housing on one end of the spectrum, which is government subsidized, generally affordable housing, tax credit finance, or other government subsidy models. That's one end of the spectrum. On the other end of the spectrum is what you're all used to, which is what I call market rate housing, which is luxury, Class A, new construction product, right? These are all defined within the new construction marketplace. So for us, basically, we're seeking to house families, multi-generational families, that's two or more related generations in a household. And also, more recently, during the 2020 pandemic, or really 2020 and 2021 post-pandemic, we're seeing a huge acceleration in the roommate categories, meaning unrelated adults coming together to economic share. Now, for families and roommate groups, economic sharing is a real key attribute in the workforce housing model, meaning that we're building a unit type, and many workforce housing developers in the marketplace are developing product types that allow these tenants to economic share, meaning to share incomes and expenses, particularly related to housing, across multiple earners. And this is a real key attribute of our version of workforce housing, but really any well-suited workforce housing product in today's marketplace is that you really want to concentrate on those households or roommate groups that have multiple earners, which does a couple things. One is it gives you advantage for resiliency, right? These roommate groups, because they have, or families, because they have more than one earner in the household, if somebody's employment situation changes, then they're able to sustain the household for the indefinite future, right? Like that one loss of income or a loss of one income doesn't impact their household in a major way. And that's true for both multi-earner households, families, and multi-earner household roommate groups, right? So the other advantage of this multi-earner household is basically reduces the load financially on each earner. So in today's environment, many people talk about that it takes so many dollars per hour wages at $25 or $30 or $50 an hour. Sometimes in California we get those kind of rates that people need to earn in order to afford the normal average rental housing or for sale housing product in a given geography. By practicing and developing the economic sharing model, we create a mechanism that allows these families, multi-gen families, and roommate groups to come together to economically share, to share incomes and expenses across the family group that allows them to then both sustain their housing situation and sustain it more affordably, right? So in many environments, you hear about overcrowding, you hear about people paying more than 30% of their income toward rent for housing, which is sort of the gold standard in the industry for what should be naturally affordable. Like a family or roommate group shouldn't pay any more than 30% of their income in order for the housing then to be considered affordable. By developing housing assets that allow and even encourage economic sharing, we're producing now a new housing model for investments. And this is one of the things that we'll talk about later is why does this housing category favor and why is it able to produce really risk-adjusted, superior risk-adjusted returns? And this economic sharing model is going to be one of the main tenets of this housing type that will allow these tenants to affordably rent these units while also producing market superior yields to investment and capital. So a couple of additional characteristics of workforce housing that we see as an advantage in the present and future investment environment is that during the pandemic, we've seen a move from hardcore central business district urban housing into suburban environments. If you listen to reports and listen to the media and sort of see the high level shift in population, that's one of the things that I'm sure everybody's kept track of and seen as part of the move. Now, one of the interesting things is that in our own research, particularly we use Zillow as a source. They've got great underlying data about searches, both in the rental and for sale marketplaces, to where people move from one location, say in the city of San Francisco. They're moving really within an hour or two, predominantly from the major urban center. So for us, we call that move going from urban to urbanized suburbs. And that's a real key component for us in our value and confidence in the future of workforce housing, is that we're really seeing a move of these both families and roommates groups into these urbanized suburbs. And so urbanized suburbs are, by definition, at least the way we define it, really older suburban neighborhoods that have been suburban in their format, their architectural format, their neighborhood fabric is suburban, really, lower density, not mid and high-rise density, but urbanized because it's not in green fields and your classic master plan community locations far out, long commutes from the city center or job centers. And this is a real key component of what we think is the value of workforce housing, is developing workforce housing projects and acquiring workforce housing assets for investments that will basically sustain them on the long run, because we're not going to either extreme. We're not going out into the greenfields periphery, nor are we staying in the central business district where we're seeing a real loss of absorption rates and loss of rents. These urbanized suburbs really sit in the middle. Again, this concept of sitting in between two product categories, really that's underdeveloped. So for us, that workforce housing model really wants to be in these urbanized suburbs. One of the things that we say about workforce housing, at least in the new construction environment, is it's built and designed to rent, but lives like a house. Many of you have heard, and many of you will research after hopefully watching this video, about the build-to-rent industry, which is sort of two different industries sort of coming together in a new space. So one, you have the master plan builder community that is normally building new construction for sale, detached houses in master plan communities like classic subdivision work. But also the multifamily industry is coming into this space of developing either detached or attached housing models. And that's really where our product category is. UTH is this attached row home style 3-story townhouse that's built and designed to rent but lives like a house. So now I want to talk a little bit about why are we choosing workforce housing. And there's really three fundamental components of our thesis, and now thesis that's been proven. We're now on our 8th UTH, new construction workforce housing project, and growing both in size of assets that we develop and the total volume of assets, and particularly post-pandemic and even during the pandemic, we've seen a significant acceleration, as I mentioned before, and particularly in the work from home professional roommate groups. And really the three component parts of why do we want to be developing, why do we develop workforce housing? Really, I've mentioned a couple of them before. So first is that we have these multi-earner households again, giving the capability for these multiple earners to sustain the housing product, to sustain their housing situation. And even though one or more of them may change their employment situations or becoming unemployed, in fact, they're able to, through the multi-earner structure, able to sustain themselves. Pew Research did a study that shows that multi-generational households, i.e. multi-earner households, have a much lower rate of poverty in the context of affordable housing and their capability to afford housing in a particular geographic environment, particularly those environments with high housing costs and stagnant or lower middle income wage scenario, that people don't make enough in their employment situation to afford normal housing, that their capability to come together multi-generational and in a multi-earner household gives them the capability to sustain better housing and also to stay out of poverty and sustain better housing situations for themselves. So that's number one, multi-generational, multi-earner households, right? The second reason that we think workforce housing is a great investment thesis is that in many markets, in fact, we're based in California, and our California marketplace is the most sort of egregious example of this, is that we're deeply undersupplied. So California has been undersupplied for decades based on our political regime, based on our tax regime, based on high costs of land and high costs of construction relative to incomes and sales prices that can be produced for housing. It's just squelched or reduced the total amount of development that's happened over now several decades. And so that puts us into a deep undersupply scenario. In fact, Harvard's Joint Center for Housing Studies did a study a couple years ago that basically studied the counties that make up Southern California, and between moderate and low-income housing needs, they calculated a 1 million unit shortfall in housing production. That was what had already been underdeveloped, not even counting what we will continue to underdevelop in the near and long-term futures in California. So by addressing a housing product, meaning workforce housing, that's introducing new product into an undersupplied marketplace, we've got high demand and low supply. Well, of course, anybody who is in the housing business, supply-demand characteristics are always going to be a factor, but we've really looked at a, very uncommon, almost contrarian move to basically move into a particular product category, meaning middle-income housing, moderate-income housing, workforce housing, that is deeply undersupplied and will be, in our estimate, particularly in California, but I think this is true for many major urban metros across the United States, that they will continue to be undersupplied. This is not a product category that's necessarily institutionally sanctioned at this point in time, although I will offer that from what I've alluded to earlier, the mainstream media, the industry generally starting to recognize workforce housing as a sanctioned, valuable product category for investment, and we're actually seeing the formation of several workforce housing funds. And in fact, our company, Urban Pacific, is working on a workforce housing fund to develop and invest in new construction assets under our UTH model. So we're actually active on that as well. Okay, so we've talked about workforce housing, why it's valuable from a multi-earner household standpoint. We've talked about the value of workforce housing in the undersupply standpoint. And the third one really is about a sustainability of the investment model. The way that we describe it is that these tenants, particularly the family groups, the multi-generational family groups, are very sticky. And how do I define sticky? Basically, sticky for me is those families that have very strong social networks locally, things that keep them living in the environment that they're in, living in the city and geography that they're in, and most importantly, living in the product and the housing that we build. Like, we want long-term, sustainable, stable tenant base. And this stickiness, this strong social networks really has a great impact on in a positive manner on this sustainability. So what does sticky mean? Sticky means strong social networks. So think kids are in school, churches close by, their commute is fairly close by. So on average, our tenant base in our existing UTH projects is between 10 and 20 minutes. That's the total commute time. So these families and roommate groups are choosing locations that are close to their jobs, or in the now newly, increasing work from home space, these tenants, particularly the professional roommate groups, aren't commuting at all, right? They're working from home. They have extended family close by. So these are all factors that keep the tenants sustainably occupying our units. Now, of course, we're very much about the social impact ethic of workforce housing. So we don't think of it in the standpoint of like this is their last option to live in our unit. We actually want to give them a superior unit, new construction. Our units happen to be 5-bedroom, 4-bath, townhouse style, 2-car garage, in-unit laundry. Now, today's presentation isn't a sales pitch about the UTH model, but I give it as an example of the sort of innovations and changes to the product category and the way that we develop assets that can now meet new component parts of the marketplace that are underserved, right? So high demand in the working family, now rising roommates, professional roommate groups, and low supply, right? From any fundamental economic characteristic, that's the kind of marketplace that you want to be in, right? And so strong social networks basically keep these families and roommate groups, but families particularly, very sustainably in these units for a long period of time, right? And so if we look at the model, our philosophy is we want to own these assets very long term, right? We believe in the model, undersupplied, again, sustainable, stable network for the tenants, right? These strong social networks, these sticky, tenant profiles, is going to basically really serve us in a very long run stability standpoint from producing market superior risk adjusted returns, right? So those three product categories or the components or characteristics of this workforce housing model are what we think give it great advantage, and one of the reasons that we're highly encouraging folks to look at the workforce housing domain as a new investment model. So now let's move on to three specific trends that we're seeing that support our investment thesis that workforce housing is a present and great future investment for all levels of investors, high net worth institutions, and family offices. So the first I've talked about a little bit is the undersupply story. So we're going to show a graph here that shows the undersupply story on a national basis. And as you can see from the graph, we're at not the generational low of undersupply, but we're pretty much close to it. Now, this graph is a little bit old. We're working on getting it updated right now, but I think it can give you a good sense of generally the undersupply of particularly workforce and affordable housing, but just the undersupply, generally. And particularly in California, as I'd mentioned before, we're, the most egregious example of undersupply, the most undersupply of all the states in the United States. So I like this graph because it basically shows supply production on a per capita basis. So this graph, the way I look at it, gets us outside of a particular market, produces more or less units. Dallas does this many units and Los Angeles does that many units, and really looks at it from a what I think of as like a holistic basis. So just a general per capita supply of housing. And that you can see generally we're deeply undersupplied. If we were to show a graph of California, we would be, the graph would be down and low and sort of bumping along the bottom for many, many years, as I alluded to before. So that's trend number one, is just a general undersupply, and a particular undersupply in the affordable housing and workforce housing domain relative to incomes generated relative to housing costs. And that actually brings me to the next graph. The next graph shows basically, again, on a national basis, sort of the differential between housing costs and middle income wages. And as you can see, middle income wages on this graph is the bottom line on the graph, and it pretty much is flat. Housing prices are going up. If we looked at it, again, this graph is a little bit older, but if you looked at it, we'd be gyrating a little bit more in the volatility of the marketplace in the 2020, 2021 era. But the reality is the differential, the gap between middle income wage earners and housing costs is still there. And in fact, we believe and see the workforce housing development model, the workforce housing investment model, as serving a product category that sits and fills that gap, right? We're a solution, or workforce housing is a solution that helps families bridge that gap between their incomes and housing costs, again, via what we've described of this multi-owner household methodology, this economic sharing lifestyle. One of the things that we can look forward to, and I don't say it's a good characteristic, but in relative terms in the 2021 era, with the amount of stimulus money that's going into the economy, I think there's a certain level of expectation of inflation increasing Now, we have yet to see it pan out, but the reality of stagnant incomes and rising asset prices, be it rents or housing costs if you're buying a house, I think this gap will not only maintain but likely increase. Income inequality, the K-shaped recovery is really demonstrative of what you see on this graph. In fact, this graph, I'm thinking of it now, is a K-shaped graph, right, relative to housing costs and flat incomes. So that's a trend that advantages and supports the idea of investing in workforce housing. The third one is an interesting one that hasn't really been talked to about a great degree, but I think most of you folks listening to this video will have seen, different examples of it. And that's the idea that we're living at the highest level of multi-generational living conditions or living lifestyles that we ever have. In fact, this graph doesn't show it, but a recent statistic says that we are at the highest level of multi-generational living in the United States in 160 years. So that means that more people are living multi-generationally than we have been going back, that many years into the past. And, this is a rising condition, right? An ascendant condition of more and more people living multi-generationally. Now, we have seen some stats recently. I believe it was 52% of the millennial generation still lives at home, maybe return boomerang, kid style. But the idea of this multi-generational living, right, two or more related households living in the same household or under the same rooftop, is a hugely growing component of the marketplace. Now, I alluded to it earlier in the video that we're at some of the highest rates of multi-generational living that we have been ever, that the economic sharing lifestyle is conducive to avoiding poverty and affording a better housing situation, and that we are, on a long run basis, the need for economic sharing and also just the general cultural acceptance of living multi-generationally is having us rise significantly over the next several decades, that this will be a much more common practice and I think culturally acceptable. Globally, living multi-generationally is the natural, marketplace, right? Like families in many other parts of the globe live multi-generationally naturally. In fact, if they didn't live multi-generationally, they would think it would be odd and strange. In the United States, historically, multi-generational living was like the way that people lived, but from the late 40s through let's say the mid 70s, we're on the bottom of this multi-generational graph. You'll note that's the bottom. That's the least multi-generational living that we ever achieved, was in the mid 70s. That basically, that nuclear family style, the anomaly in time of the idea of the nuclear family is changing, is being disrupted. I think as any of us who are reading the news and tracking economic cycles. So these three trends are really, I think, the ongoing historical, ongoing presently, and the future trends, really most importantly, of what support a workforce multi-generational housing model. All right, now as we start to wrap up this video, I really want to highlight two parts of this workforce housing industry that I think give a significant advantage from the standpoint of investment value. As a real estate developer, we're always looking to be competitive in two separate spaces, although they're related. The first space is attracting tenants, and the second space is producing market superior risk-adjusted yields to investors. Like our job as developers, we need to do both of those. So innovating inside the space of product category is a lot of what we've talked about. Like, why are these projects, these workforce housing projects, different? What makes them attractive to tenants? But I want to talk a little bit about how we see that in relative terms to what I call tenant innovation, right? The innovations that produce tenants who want to lease our units at the rates that we want to produce and ultimately serve the return characteristics that we're talking about. So for our model, we build a 5-bedroom, 4-bath new construction townhouse. So the way we describe is built and designed to rent. It's built to rent and lives like a house, right? Like, this is the key component part. So we have a 2-car garage, we have an in-unit laundry room, we have air conditioning, like all new systems. This is obviously a brand new product category. And again, my point is not to sell you on UTH, but to give you a background as an observer, as an investor, an observer of the marketplace, as to what you could look for if you're identifying the workforce housing space. So like, why should I invest in this space? Like, what's important about this project or that project this offer versus that offer to, produce superior returns and a valuable investment for you as an investor, right? So the reason that's important, like our format, is that basically, again, as we've talked about, we're able to provide a product category, an underserved, undersupplied product category to families and roommates that is superior to things that they will find in the marketplace. And this is a real key. What we want to continue to be able to attract tenants. We want to keep them sustainably. We want them to, pay affordably from their incomes, but have it work from our standpoint as an investment model to produce, risk-adjusted market superior returns. So multi-generational is part of the tenant innovation, right? If you think about it, other than rental houses, nobody's really serving this multi-generational family category. Now, the interesting thing that I've alluded to before is that we've seen, at least in our offer, a huge acceleration in the work from home, what I'm calling location agnostic professional roommate groups. So think of it, these are roommates that are older than your typical roommates. So these are, post-college, professional working groups that have all been released from their obligations to live geographically co-located to their work environment or their careers. Their companies have released them to work virtually wherever they want. And we're starting to see a massive increase in what I call affinity groups, right? These are roommate groups that had or have reason to live together. They've all been released from their job locations geographically, and they're wanting to live with people that they like. So think like former college roommates that loved living together. These working groups, these working roommate groups aren't families. They're singles or couples that are choosing to live together, again, to practice the economic sharing lifestyle, but now they can live wherever they want. The term location agnostic is what I mean by that, meaning they don't care where they live. I mean, they do care where they live for their lifestyle, but they don't care where they live from their work and career standpoint, right? So what we're seeing, at least in our offer, and we would suggest other people can look at this product category also, is to start to tailor your units to capture this work from home space, market demand, right? Meaning multiple bedrooms, economic sharing, locations that are in these urbanized suburbs, like I've mentioned before. All right, so these are the sort of innovations that we're talking about. We are going to be co-located to cultural amenities, right? And this is one of the things that we suggest people as you're reviewing your own investments in the workforce housing space, that you look for projects that have these characteristics in them, that they're not so far out on the periphery that there's no cultural fabric, there's no amenities. And yes, we're in the midst of the 2021 pandemic, but the reality is within some number of years, we're going to return to some normalcy. It will be a new normal, of course, but that people are going to be excited and wanting to be out in the social environment. And that's going to be one of the things that they'll look for, particularly in these more discerning workforce roommate groups, right? One of the things for us, the 5-bedroom, 4-bath category has been a huge demand generator in that space. In fact, we, in many of our units, will have 3 roommates that rent the 5 bedrooms, and then they use the extra 2 bedrooms as the work from home space. So the last part of the tenant innovation, and this is really more in the economic sharing family, middle income family lifestyles, we're producing and would encourage any project that was looking at producing in the workforce housing space to be competitive and be innovative, is to provide naturally occurring rents that are affordable in the context of existing incomes, right? So in this 80 to 120% of median income space, think about your workforce housing projects as wanting to fit inside that as much as it can be. And there's obviously infinite number of formats that can, conducively supply housing to these income categories. But we would say that in the workforce housing space, that would be one of the significant competitive factors, is how well do you do that or not, right? As you assess your own investments and in the future, how this be one of the key component categories. Now let's move on to the investor innovation component part of this. And many of these you've heard me talk about before. Right, so we're delivering units into deeply undersupplied marketplaces, right? Like this to me is the most important part of what we do. The real estate development industry, the new construction, apartment, multifamily development industry does not have a good history of moving into undersupplied markets, right? Like the typical developer move is to, go into a market and everybody's doing X, Y, or Z product category, and that must be great. And so let's do that too. Now I'm oversimplifying, I'm generalizing on purpose so we don't have to sit here for days and days and I explained, demand and supply characteristics in the real estate development space. But the point is that you want to, as an investor, be focused on product categories, geographies, tenant profiles that are undersupplied. Now, undersupply can have, two sides of that coin, right? I always get there's no supply in that category because there must not be any demand, right? And that's true in many cases. But there's the other side of that coin, which is that the innovations required to produce housing that moves into or develops into undersupplied categories may just be beyond the normal development marketplace's ability to innovate and take risk and be creative in that space. I've been doing that my entire career. Like, that's really the only way that we want to be in the development space, is to be innovating within the auspices of producing viable, executable projects. Like, you can't, and we don't want to be so extreme that the product doesn't work and it's, on its face value is so extreme that, you could look at it, and not have to do much research and know that it's not viable. We've done a lot of research in this workforce housing domain, particularly in California. We know that for decades we have been an undersupplied model, and in the mainstream media and most of the development industry is focused on the what I call true affordable housing space, which is rightly so. These are families that are at or below 60% of median income, down to the very lowest income categories. That is where the need is greatest, and we acknowledge that. But what we also say is the ignored part of the market segment, these middle income working class families, have been underserved for a long time. In fact, they're still not being served efficiently and effectively. We're doing our part to deliver a product into that space. But I would encourage you as an investor to look at that as a model for any investment. If you've chosen the workforce housing model as one of your investment thesis, to look at that characteristic. The second characteristic that we like for investor innovation is the multi-generational, sticky social network, strong social network characteristics of this. Now, the work from home roommates don't have, in our estimate, the same sort of social networks that we see in the family category. So we really look to the families to live this style, but they're coming from local, their kids are in school, their extended families close by, their jobs are close by. And that really presents to us, and we've already seen it in the 4 and 5, almost 5 years that we've been doing this offer, is to really create a very stable, sticky, strong local social network characteristics of tenants that have these folks live in these units for a very long time. We don't want to have people that move at the drop of a hat. And for other demographics that are more socially mobile, say young folks, Gen Z and millennial, they are more naturally mobile. That's part of their life cycle, and that's perfectly logical, right? That they should do that. That's how they are. Young folks need to be more mobile. But what we just say that we want to rent to a tenant profile that is stable, that is there for the long run, and have that be a central component part of our investor offer, and what we'd encourage you to look for in your own workforce housing investments. So that completes what I consider to be the tenant innovation and the investor innovation components of today's presentation. All right, now we'll go to close this video out, and we appreciate you guys sticking around this long. We are a firm believer in the workforce housing space as an investment thesis. In fact, we're such believers in the space that we have dedicated the entirety of our company's operations to developing new construction workforce housing assets. That's how much we believe in this space. We believe it has a long-term stable future. We believe it has a long-term undersupply story. But we're going to have to continue to innovate. And so, like anybody in any marketplace that is continuing to innovate, where the market's drifting, where the economic cycle is producing new different demands and new different effects on tenants and investment returns, we'll continue to work on innovating new product types. So we appreciate you staying with us today. Again, my name is Scott Choppin. I'm the CEO and founder of the Urban Pacific Group. You can find us at our website, www.urbanpacific.com. We appreciate you joining us today. Thank you.